Good morning. This is Marshall Gittler with the IronFX Global Daily Comment for Monday, June 23rd. The market's apparently still mulling over the implications of the FOMC statement and FOMC Chair Janet Yellen's comments. Fed funds expectations for 2017 are back almost to exactly where they were on the Monday before the meeting, as are longer bond yields. So there's been mean reversion in the fixed income markets. In other words, at the end of the day, the fixed income market doesn't see any real change in view at the Fed. On the other hand, the VIX index remains notably lower than before the meeting. U.S. stocks rallied for 6 consecutive days, and the dollar is weaker across the board against both the G10 and emerging market currencies. So the question is, why mean reversion in fixed income isn't accompanied by mean reversion in the FX market? And my guess is that it's due to the Fed's view on accelerating inflation in the U.S. Inflation is rising faster than nominal yields are, meaning that real interest rates are coming down in the U.S. Yellen dismissed the recent acceleration in inflation as noisy data, but the trend does seem to be upwards. Moreover, Canada's CPI for May, which was released on Friday, was well above expectations, and U.S. and Canadian inflation tends to move together. With the FOMC still focused on the employment side of its dual mandate, U.S. yields are likely to move lower, which may slow any dollar rally from here. Note that this makes Thursday's May PCE deflator number and Friday's preliminary June CPI for Germany all the more important as indicators of where real yields are headed. We may get some clarification on the Fed's view when Yellen gives the inaugural Michael Kambdousis Central Banking Lecture at the IMF on the 2nd of July. That'll be followed by the non-farm payrolls on the 3rd of July and the FOMC minutes on 9th of July. The dollar is opening mixed this morning, higher against the Swedish krona, Swiss franc, and the euro, and lower against the commodity currencies, the Canadian dollar, Australian dollar, and New Zealand dollar. In the emerging market world, the South African rand and Mexican peso gain strongly, while the Polish zloty and the ruble are lower. It looks like the market's favoring those countries that may tighten monetary policy while selling those where policy may be loosened. The South African rand was probably boosted too by Saturday's reports of a breakthrough in talks to end South Africa's longest ever mining strike. Details of the agreement will be released today, and I'd expect it to gain further once the details are out. The commodity currencies are also beneficiaries of much higher than expected rise in the HSBC market China manufacturing PMI for June, which is out over the weekend. The surprising return of this gauge above the 50 level for the first time this year buoyed copper significantly. The recovery of growth in China, plus rising oil prices on the back of Iraqi tensions, should mean more gains for the commodity currencies. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.